So now we're going to talk about business economic factors that we need to know for the SIE exam. We need to understand certain things about the balance sheet. The balance sheet is going to contain the assets and liabilities, either of a corporation or a person. Balance sheet is the assets and liabilities. Net worth is assets minus liabilities. You may see net worth written as basically shareholder equity. Shareholder equity and net worth mean the same thing. Stocks and bonds are assets. Credit card balances are liabilities. The income statement records the income and outflows of money. It's also the cash flow statement. The stock we own is an asset, but the dividend we receive from it is a cash in. The bond we have outstanding is a liability. We owe that money. The interest we pay semi-annually is a cash out. We want to make sure that we understand that the bond is going to be on on the balance sheet, while the payments on the bond are recorded on the cash flow statement. We also have the business cycle we need to understand. This is sort of, at least the words and names we should be able to understand. Like we have the trough, the bottom, we expand, okay, we're growing. We have a peak, okay, contraction, okay, trough. That shouldn't be the problem, but sometimes they may ask about certain economic facts about those kinds of cycles, where in the cycle we are. So you may want to look through this. It's not likely to be any more than one question. This may be something you want to have written down to look at right before you go into test, just to try and remember. A lot of these are going to be, if they're asking about one, if you know what the others are, you're going to be able to figure out which one it is as well. So you don't necessarily need to know all of them, just enough to help process of elimination sometimes. But here they are. During an expansion, GDP is increasing. Unemployment is around the target level. Inflation is near the target level. The stock market is bullish. It's going up. There's lower inventories because there's higher sales. There's higher demand, higher consumer demand. When we hit the peak, the economy is now basically overheating. GDP is growing above the target. Inflation is greater than the target. We then go into contraction. We head downhill. Growth weakens. GDP now falls below the target. There's now higher inventories due to lower sales. There is lower consumer demand. They're going to be the opposite. Contraction and expansion are opposite. Peak and trough are opposite. Trough is the bottom. It's the opposite of a peak. The economy is at the bottom. GDP is below target and inflation is less than target. Generally, these are known only in hindsight. We don't necessarily know where we are now. We might know where we are now when we look back 2 years from now. The coming market boom and the coming market crash. This year, both were written by the same author. Now we have that market cycle, the economic cycle. We also have things called indicators. These help tell us where we might be headed, where we might be, where we're headed, where we currently are, and where we have been. Where we are headed is leading, the indicator that tells us where we're going. They lead the economy. Things like the money supply, how much money is actually out there. Average weekly unemployment claims, building permits, manufacturer's orders, S&P 500. Now, unlike contraction, which would generally be thought of as negative, and expansion, which would generally be thought of as good, indicators aren't necessarily good or bad. They simply tell us where we're going. A good leading indicator, money supply going up. I believe that's the good indicator. These can get very weird sometimes when you're trying to think what they mean. When money supply is going up, that's a leading indicator of a good future economy. If money supply is going down, that's a leading indicator of a bad future economy. So you got to look at what these are and if they're negative or positive for what the indicator is saying. If it's a leading indicator and they're positive, that means it's indicating the future is going to be good. If it's a leading indicator and negative, it means the future is going to possibly not be good. Lagging indicators are indicators that tell us where we have been. They lag behind the economy. Prime rate investing, changing consumer price index for service, the duration of unemployment. The average weekly unemployment claims is leading, but how long that unemployment lasts is a lagging indicator. The coincident indicators are the indicators that tell us where we are. They tend to move with the economy. They coincide with where we currently are. non-agricultural employment, the GDP itself, industrial production, personal income, manufacturing, and trade sales are all coincident indicators. We also have indicator of inflation, primarily the Consumer Price Index. This measures the cost of a standard basket of goods, including a number of products and services, and basically every year they look at what the price of that basket is and see it slowly moving up, and that's how they measure how inflation is going. Now, there are some basic effects on bonds and equity markets. We have cyclical events. These are stocks that go up and down. They follow the business cycle. Things like auto, steel, and heavy equipment, things like that. We have defensive securities. These are stocks that generally are resistant or immune from downturns. We want to think about tobacco, alcohol, food, utilities. If you think back to the crash of 2008, do you think that Marlboro lost sales? You think Budweiser really suffered in loss of profit? You think maybe those two might have actually gained profit? You think maybe people started smoking and during the market crash, started drinking more? Maybe. Alcohol and tobacco are what I always think of when I think of defensive stocks. There are growth stocks. These are stocks that have a low dividend, generally trading at the higher end of 52-week ranges, and are focused more on capital growth. They generally do not pay dividends. If they do, they're very low. Value are stocks that generally have higher dividends, generally trading at the lower end of 52-week ranges, not necessarily going to have capital growth. Potentially, these are companies that the managers believe are simply undervalued, that they're a good value for what they do. There are some principal economic theories we also need to understand. These generally aren't being tested a lot, but occasionally. Keynesian is in short run, especially during recessions, economic output strongly influenced by aggregate demand. Can also be thought of as demand side. If you sort of pump money to the demand side through generally government spending, basically pumping money into the economy, that's Keynesian idea on economic theory. We have the monetarist theory. That's where changes in the money supply, the Federal Reserve Board system is monetarist theory, where changes in the money supply are the most significant determinants of economic growth and the business cycle. We also have supply side economic to sort of coincide with demand side. Economic growth can be most effectively created by lowering taxes, deregulation, and work on the supply side of the market. Now, in the United States, we use all of these. All three of these. We clearly have a Federal Reserve Board that's monetarist. We clearly do government handouts, government funding, government sponsorship, government payments of certain things. That's increasing demand. That's demand side. And we certainly look at lowering taxes and deregulation to help with the business side, the supply side. We try and use all of the theories because they're theories. We don't necessarily know if they're right. Sometimes they do good things. Sometimes they fail. They're theories. But that's what the basic economic theories are. The gross domestic product, GDP, and the gross national product, GNP. The GDP is all production within the boundary of a country. Consumption plus investment plus government spending plus exports minus imports plus the difference between them. Everything that is produced within the United States is the GDP. Everything produced within the boundaries of France is the French GDP. GNP is production of the citizens. If there happen to be French citizens working in the United States, their production benefits France's GNP. Just like if there are U.S. citizens working in France, their economic production counts for the U.S.'s GNP. GDP is within the country. GNP is by the citizens of that country. More economic and money stuff. We've talked a little bit about inflation in the last unit when we were talking about monetary policy. Inflation refers to a general increase in the price of goods and services. This occurs when demand for these items grow faster than the supply does. The result is more money chasing fewer goods, and therefore prices are going to be increasing. Deflation is a general decline in prices, often caused by a reduction in the supply of money or credit. Deflation can also be caused by a decrease in government, personal, or investment spending. Neither is necessarily good, neither is necessarily bad. You need a little bit sort of the balancing act. Stagflation is sort of that unicorn of economic systems and economic events. It's a condition of slow economic growth and relatively high unemployment. It really doesn't happen, at least not for extended periods of time. A time of stagnation accompanied by a rise in prices or inflation. Normally, stagnation causes level prices, maybe slight deflation. But when you combine it with inflation, it can be incredibly dangerous. I believe Japan lost a decade. They refer to it as the lost decade, where you basically look at, I think it was the 90s. I think if you look from basically 1990 to 2000, Japan stayed perfectly flat, like they didn't go anywhere. They had no growth because they were suffering stagflation, unfortunately. It's always something that you sort of hear, oh no, if someone does this, it's going to cause stagflation. It's a very rare occurrence if it does, but that is the definition. That brings us to the end of this unit. I hope you found it useful. Make sure that you do pay attention to the information below. There's going to be some additional resources below to help with these topics. And I'll see you again shortly.